Ken Sleeper, the goal of the Sierra Strategic Income Fund is to limit losses to 4% or less. It's been awfully volatile so far this year. And of course, you're a multi-sector bond fund, so that helps. But tell me, how are you doing it? How are you limiting the losses?
Well, first of all, we're very careful in our asset allocation. We make sure that we're invested in productive asset classes. For instance, preferreds, muni bond funds, high-yield corporate bond funds when they're appropriate. Second, we select the best mutual funds in each of these asset classes. We just don't select losers or dogs. We go through a very stringent selection process. And third, we have mathematically driven sell stops. So we're not going to buy and hold a particular position and wait for good times. If that particular mutual fund is turning down beyond our mathematically driven limits, our sell stops, we're out. For instance, recently in this very volatile period of time, we've had a number of sells as our stops are reached. So we're very careful about managing the downside risk.
A lot of people say that the Federal Reserve is the cause of a lot of the volatility because they're keeping the market in limbo with regard to the interest rate hike. There's a lot of indecision there. How is that affecting the way you manage your fund?
Well, on a day-to-day basis, it doesn't influence us in terms of a buy or sell decision. But personally, I think that their actions have been more destructive than constructive recently. I would have liked to have seen just a teeny tiny rise in rates. I think that would have been more productive for the market. What it does, though, it helps us shape our asset allocation. Where do we want to invest? What asset classes do we think are going to be productive going forward? And that way, we have to be attentive to the Fed. We have to be attentive to what's occurring globally in our asset allocation.
And one asset class you're in is corporate bonds. I think a quarter of the fund is in corporate bonds. Tell me what you look for right now in a corporate bond.
Well, we've actually trimmed back some of our corporate bond positions, but we will diversify into different asset classes within the corporate bond structure. For instance, high-yield corporate bond funds, after a recession, for instance, when spreads have peaked and look like they're coming down, can be very productive and can give us really very unusual returns on a risk-reward basis.
So you like high-yield bonds right now because there's a lot of worry about them in the market. You're hearing this from Carl Icahn. He's even doing videos about it.
Well, good old Carl. Well, right now we are not allocated to high-yield corporate bond funds, but we have our eyes on that asset class because we know that the world isn't going to go down forever. We know that eventually there'll be a turnaround. And so we're preparing ourselves for the next set of buy signals. And high-yield corporate bond funds are on our radar. Emerging market debt is also a productive area, but not all the time. And that's the key to our success, is being prepared for the turnaround and doing our homework now.
But in the meantime, your fund also tries to get 6% to 8% absolute returns, total returns, if you will. How hard is that with a Fed that is keeping interest rates so low? A lot of people call it financial repression.
I agree. It's been very tough right now. That's why we're looking at areas like municipal bond funds, believe it or not, are very productive. They've been flat for about a month or so, but we're starting to see a little bit of rise now that certain areas, maybe in Puerto Rico, are resolving themselves. We are also looking at preferreds. So we're trying to get yield in ways that are consistent with the goals of the fund. And that is, again, as you said, we want to keep our losses manageable, 4%, let's say, after all fees. And we want to get a total return of about 6% if we can.
And then finally, how do you avoid the landmines in the municipal bond world? You hear problems in Illinois, in New Jersey, a lot of worries about pensions out there. How do you make sure you don't get one of those bonds or bond fund which contains a lot of those bonds, blows up your fund?
Well, the key is to not buy individual bonds. I think that there's over 1 million different issues of muni bonds. So we look for mutual funds, we look for portfolio managers that have experience, and then we monitor each of those mutual funds. And if they fall beyond a certain point, we just sell. We move to the sidelines. So that's the way we do it, the diversification that a well-managed mutual fund gives us.
Thanks a lot, Ken Sleeper.
Thank you, Greg.
And thank you for watching The Street.